afternoon, everyone, and welcome to the Global Market Outlook for the 9th of November 2023. What we're going to be discussing is how to position your portfolio into year end. For those that have been on the call before, we generally go through some basic economic indicators. We try and understand where we are from an economic point of view. We look at some commodity prices. We look at some of the major movers in financial markets. I then review our global equity portfolio and discuss any new investment ideas. I'm only talking about one stock today. Sometimes we try and do about 3 stocks usually, and then I've also got 2 structures that I just want to discuss, which I think maybe the timing is appropriate for them. Who should be watching this webinar? Who is on the call? Generally, it's our clients, and potentially you're not a client, and you just you maybe saw the on the database or saw it on Twitter or something like that. But essentially, our clients are broken into 3 different distinct categories. The first is our securities broking clients. These are already self-directed traders. We give you either an investment account if you're a buy and hold type investor, your active trading accounts for guys that want to jump in and out of the market, and of course our forex dealing business sits in there as well. These are guys that you're probably on the call because you want to hear what stock picks are we doing in the managed solution side, what things can you go and buy yourself. Potentially you're looking for some levels or just a general overview of where markets are, but it's because you're taking care of your own money and you're just using our systems essentially. The second kind of client is our managed solution clients. So these are clients that have used one of our investment products. So they're either in one of our portfolios, you might be in the global equity portfolio, you might have bought some of our structured products, and you just want to hear about, what are our views on the market, what's happening with the money, how are we thinking about investments going into the end of the year, and a little bit of a review of the performance and to understand where we are at from a performance point of view. And then the final segment of our client base is the wealth and advisory clients. So these deal with our wealth managers. They have a very close-knit relationship. You're not just buying an investment product from us. You're actually using us for advice. And generally, we discuss your whole portfolio, everything. We look at your objectives. You look at who you are as a person, and then recommend which investment products to use. Not just offer you investment products that we've created. So those are kind of the 3 types of things that we do, and it's 3 types of clients that are on the call today. Obviously, if you're not a client, enjoy. Please feel free to ask questions as well. You can either use the Q&A function or the chat box. Obviously, this is a live webinar, and you've taken the time to come and see us today. So use the feature. I usually leave questions for the end, but if there's something that pops up that's interesting, I might answer it as we go along. But that's kind of the format that we'll go through. So without further ado, let's move into the economic indicators and where we are at the moment in terms of underlying economic data. So let's start with the US economy, obviously the biggest economy in the world. And where is that currently? So we're at an interesting junction point, if you want to call it that. And the kind of questions, I've just come back from a roadshow in Durban, and the kind of questions that we've been receiving from our client base there at least were, if there's a recession in the US, how is that going to affect markets? If unemployment in the US rises, how is that going to affect markets? And it's always a very, very difficult question to answer because financial markets are one of the best predictors of economic activity. Economic activity what happens with the economic activity comes after the prediction. So it's all about how, it's almost like you're looking in the rearview mirror trying to predict what's going forward. And remember, a market is a prediction mechanism. When you're investing in financial markets, we're trying to make a prediction of a prediction. And that's why it's so difficult. That's why, trying to call which direction things are going to move in is very, very tough. And, there's a million models that we can apply and a million lenses that we look through to try and understand this. And we dedicate just about all our time to trying to understand this. And if you're very, very good, you make a lot of money. But looking at the underlying economic data, where are we at the moment? And where we're at the moment is, obviously, we've gone through a period of very, very high inflation. You can see from the US inflation figures, this is just the headline inflation figure. Kind of middle of last year, we were at 9.1% inflation. Now, this had all sorts of causes. I mean, we were coming out of we were still dealing with the turmoil of the reopening after a pandemic. We had the Russia-Ukraine conflict, which spiked commodity prices. I've got all the commodity charts up, a little bit late in the presentation, but huge run up in commodity prices. What are commodity prices? They're the input to all the goods and services that we use. They're going to fuel food price inflation. Higher oil prices are going to make transport more expensive to move goods around the world. So we had that kind of environment, and we've had a slow moderation now to obviously handle the high inflation environment. The response from the Fed was obviously to hike interest rates incredibly aggressively. And I've got a longer term chart of the federal funds rate on the bottom right hand quadrant, and you can see last meeting. So we do these meetings every 3 months. Last meeting we looked at it, and I just gave you a shorter term view of everything. I think we did everything on the 3-month view, or at least the 3-year view. Here I've decided just to zoom out a little bit on the Fed funds rate and just show you what's happened to the Fed funds rate over time. And you can see, and one of the things you should pick up from the chart on the bottom right is just how fast these interest rate increases have happened. If you look at previous tightening cycles, they've been a lot more moderate. So what the US central bank has done this time around, it's really just put the foot straight on the brakes. There's been no easing into the stop street. It's seen something going wrong, and it just slammed on the brakes immediately. Now, typically, it takes 12 to 18 months for this to feed into the underlying economy, and we're starting to see that impact now. Now, what everyone is looking at from a market point of view is we're waiting for that recession to hit, or at least the recessionary conditions. We want to see bad unemployment numbers. We want to see a cooling of the underlying market, because that is the expectation that we have. And when that happens, then everything is good, because we've already made the prediction that the US is going to go into recession. Now, if it doesn't go into recession, if it doesn't behave as we expect, that's when we start to get nervous. Now, on a short-term trading point of view, you can see that in the economic numbers. So if you look at the quadrant on the top right, that's the US unemployment figure, and we have the non-farm. I normally try and do this for a presentation just after the non-farm payrolls figure. We were expecting 180,000 jobs to be added. We got 150,000 jobs added last Friday. We were expecting the unemployment rate to be 3.8%. It came in at 3.9%. So we had fewer jobs added to the US economy, and we had the unemployment rate lifting a little bit more than we expected. What happened was we immediately saw a weakening in the dollar index. So the US dollar started to weaken. That's why, when we look at currencies, you'll see that the rand has strengthened, against the US dollar significantly. And there was a little bit of risk off trade. I think we've had 9 up days on the NASDAQ in a row. Now, why is that happening? Because things are happening as we want them to happen. We want the US labor market to weaken. We want things to cool down in the US. You can see on the bottom left-hand quadrant, US annual GDP growth. GDP growth is way too strong in the US at the moment. Now, that seems kind of counterproductive, but when we know from a long-term perspective, when you take a long-term perspective in economics, high inflation or essentially a devaluation in money, a rapid change in the price of goods and services, and the pace of change doesn't really matter. It's rather, is the pace of change changing? That matters. So does currency essentially act as a store of value? That's incredibly important to long-term sustainable growth in economies. So what we want at the moment is we want the US market to cool down, and we want inflation to subside. That is absolutely key. Now, all of that has been happening as we want. And if you listen to the FOMC meetings, it's kind of the US equivalent of our monetary policy committee meeting. You will hear Jerome Powell has got this really weird kind of stance on monetary on how inflation is going to come down. And he says, I am the first to admit this is against the historic record, but he thinks And he says this is even not what the committee is saying, but what he thinks personally is this might be a situation where we see inflation come under control without a significant weakening in the labor market or the growth prospects within the US. Now, that's an incredible statement for him to have made in a central bank meeting, because usually the mechanism with which you get inflation under control is that you kill the labor market and you kill growth. And by doing that, inflation dips. And now he's kind of, obviously he's talking about, specifically in the underlying commodity markets, which was very much, that inflation was driven by, kind of factors outside of the usual economic cycle, things like, the war in the Ukraine, and things like COVID, very, unusual circumstances. So hopefully he's right. It will be very strange if he's right, but if he's not, and inflation goes up and growth starts to slow down in the US, that might be a good thing for markets, because that's how we've seen the markets reacting. As I said, NASDAQ going berserk. Why specifically tech stocks? They like lower interest rates. What does this mean? Interest rates are probably going to fall at some point in the nearer future. And you can see, again, I'm going to look at our interest rate expectations in the next slide. But if you look at the bottom right-hand quadrant as well, you will see that we have only started, even if we are at peak at the moment, you can see, just before global financial crisis, around that era, a long time before, a long plateau before the dip in interest rates. The same, around the early noughties, a long plateau before interest rates start to fall. Now, the question is this cycle going to be a very steep hike and then a very steep cut? Is that, it's kind of a new way of doing it. You almost don't let the interest rates start to affect the market, and then you're already dropping them. So the longer duration debt doesn't actually become a problem, because, obviously if you've got 30-year loans and, you don't need to refinance them, but, the longer interest rates are high, the more debt needs to be refinanced at higher rates, the more aggressive the tightening and the quicker the tightening of financial conditions will be. So is this going to be different, where we suddenly see a much more rapid drop in interest rates? We don't know, but we've got obviously ideas. The market has signals that it explains to us. And obviously that's going to feed into your equity outlook. If interest rates come down quickly, you should be buying equities hand over fist at the moment. If we're going to go into a long plateau, the cooling of the underlying economy might be more than we expected. And then we'll see that equity markets haven't fully priced this in. Then we could be in for a very negative period in equities. So it really all comes down to how fast are interest rates going to come down from here. So if we look at this is the FedWatch tool. You guys can also get it. You can just Google it and pull up the probabilities, but this is a nice kind of general slide for you. Now, these are the next couple of Fed meetings, and then I've gone all the way out to June. So I've got I've skipped the May meeting and gone all the way out to the June meeting next year, middle of next year. So overwhelmingly, the probability, if you had to bet yes or no, and there was a 50-50 chance for you to make a bet, this is how you should bet on interest rates. 13th of December meeting, 90.4% chance that there is no change in the federal funds future. That's just a continuation of the plateau in the federal funds rate. There's just under a 10% chance that we'll see another interest rate hike. The overwhelming probability here, and I mean, remember, this pricing moves around, these probabilities move around on a daily basis, not dramatically, but I mean, you can go and ping them. I pinged them all this morning. 90% chance, no change in December. So looks like we're going to be flat in December. You look out to the January meeting, call it an 83% chance, no change in January either. It's starting to look more and more that we have now reached the peak of the US tightening cycle. There's about a 16% chance by January that they might have had to tighten one more time. Of course, as the Fed will tell you over and over again, it's all data dependent. It all depends on what is happening. What do the inflation prints look like? What does the labor market look like? What do GDP figures look like? And a host of other inputs that form their opinion. If you look at the dot plot, though, they are, like the Fed is also predicting interest rate cuts, but it is, of course, data dependent. We look out to the March meeting in 2024, so the end of the first quarter. Now, the reason that's interesting for me, I have been saying all year, I think we're going to get a cut by probably in the first quarter was my pick. I know the general meeting that we hold in every January, we make our big calls. We thought it would be a little bit quicker than that. We thought that you might actually get a cut towards the end of the year. We just haven't seen, that strong GDP print from the US. Inflation has been a little bit more sticky. The labor market hasn't weakened as quickly as we had hoped it would. And yeah, it looks, I even in the meeting, if you go back and watch that video, you'll see I said, don't you think first quarter, but we decided to predict end of the year. It does look more like, if I had to make the same estimate today, I would say we're going to get the cut in the second quarter of next year. But if we look at the end of the first quarter, I've still got about an 18% chance to be right. So, but probably 68% chance that there will be no change to interest rates, and we'll still be continuing the plateau in US interest rates by the end of the first quarter. Like I said, skip the March meeting. What are the chances that we'll get a cut in interest rates by the end of the second quarter next year, according to current probabilities? As you can see, there's there's only about a 3.6% chance that will be higher than where we are now. There's about a 24% chance, so 1 in 4, that interest rates will be in the same position, and the balance, so call it 75% roughly chance that we'll have an interest rate cut by the end of the second quarter next year. That looks like where interest rates are going to come down. Okay, so how would you suggest investing? Okay, so yeah, so I've got a question. Generally speaking, how would you suggest investing strategy for 2024? ETFs, index funds, individual shares, commodities, and other. That is pretty much the second half of the presentation. So yeah, we're going to cover a lot of that. Index funds I'm particularly concerned about, and I'll kind of handle that question. I'm going to handle that question in a second, but let's maybe skip ahead. I'll go very quickly through the next slide. Next slide is just where's the South African economy at the moment. I think we all have a sense of global versus local in terms of where we're at. Our unemployment number, is a little bit better than it was, but we have structural issues within South Africa. The repo rate has climbed up. I think we're all feeling that. From my point of view, a fixed income in South Africa is actually fairly interesting. I mean, we're getting very, very good yields domestically. And, if I'm looking at a Reg 28 framework for a client, I don't mind kind of keeping some of the fixed income exposure within the South African context, but putting more of the equity exposure into the global context. I think the equity market in South Africa is going to have a very difficult time. But I think some of the fixed income markets and the fixed income products are looking quite attractive locally. Our GDP growth, it's shoddy. I mean, for the potential our country has, for what we actually managed to deliver, it's very, very poor. So many things that we can improve. We saw a strengthening of the currency on the medium-term budget policy statement. Basically, finance minister has come out in South Africa and said, well, we've got major problems, and debt to GDP is going to continue to weaken, but a little bit of optimism around the fact that there were no provisions for state-owned entities. So maybe we've admitted that we have a problem, and that's the first step to fixing a problem. But again, going into elections, I think essentially hands are tied. A lot of people, a lot of people I speak to complain about the social grant system. We think that, government is there to protect the weakest in an economy, and the social grants are absolutely crucial in South Africa to allow, you cut social grants. I mean, people starve. It is a horrible situation. Crime rates go through the roof. It almost becomes unlivable. So nothing they can really do on the social grant side of things. A difficult position for the South African fiscus. We need growth. We need a lot of things, but a difficult place to invest. Like I said, the only place that we kind of see like area of investment that we find particularly attractive is the bond market. And then obviously within the Reg 28 framework, we do use the local, I've got literally a local portfolio sitting inside my Reg 28 cash. Where we do a local equity portfolio, and it's very much it's designed for very unique opportunities within our context. Again, some of our equities, and you have to be I don't think the index investment here is the right way to go. Buying a top 40 ETF and hoping for the best, I think you're going to do badly. I think there are some very unique and very interesting investment opportunities within South Africa, but you've got to be very, very selective. And our local portfolio is quite concentrated in what we believe those opportunities are in the listed space. Inflation in South Africa coming down, but essentially, we import a lot of inflation. So the global picture is going to affect our local inflation rate anyway. But now, Oh, okay. So it's sentiment. Sorry, it's 2 slides on, but I'm going to answer the question about in the indices versus individual shares, and we'll talk about commodities. So we will get there, Peter, at least. Yeah, so okay, so that's kind of my view on the South African economy currently. Some very, within a Reg 28 portfolio, I mean, you probably want to be picking up things like we've got some interesting entry points into commodity stocks. So things like Billiton, Glencore, we like. Obviously having like an exposure to Naspers, Naspers has come off a lot. They've simplified the structure of the business a little bit. We think that's interesting. We like the education space as well. So Curo, Stadio, Advotech, all looking interesting at the moment as well. And you might see a big lift in the retail side of the market. I still think there might be an opportunity there. We like ShopRite's a little bit more expensive. Woolly, sitting at 20 PE versus Woolies at 15. Mr. Price at about 10. Or at least Pick n Pay at about 10. Pick n Pay, big issues within Pick n Pay. I put a short out in the Financial Mail around Pick n Pay at the beginning of the year. It looks great. I still wouldn't be buying the business. ShopRite is the kind of the steady Eddie in the segment. But like I said, individual opportunities here. Just buying an index probably not going to work, because I think you need to be quite au fait with the South African market to be able to invest successfully here. Okay, but let's look at, before I get into kind of the underlying, basically what's the big movers, let's look at the market sentiment. So what's been happening over the last little bit in the markets? I always use the CNN Fear and Greed Index because it's a nice composite of sentiment. It uses a whole lot of different sentiment gauges. One of the inputs is the VIX. So the chart on the bottom left-hand side is the volatility index. CBOE volatility index, and you can see I think last time around I gave you a longer term chart showing you that the VIX, in a crash, the VIX will spike to about 80, 90 is where that index gets to. Kind of on the long run average, you sit between kind of 12 is low volatility, 20 is starting to get to high volatility, 30 is exceptionally high volatility. Last year we had very, very high volatility. This year it's come down, and we've seen again after that weakening of the non-farm payroll number, the weakening of the US labor market, and the idea that we might get interest rates coming down. We saw volatility drop significantly in the market. Like I said, NASDAQ up dramatically. But this index has a lot of other, so it's got like the put-call ratio. There's a lot of other little sentiment gauges, and it's a nice composite. But you can see at the moment, last time we spoke, we were kind of in the middle of the greed cycle. Was greed versus extreme greed. Obviously, the way that you want to read this as an investor is you want to follow the old Buffett philosophy. You want to invest. You want to be greedy when others are fearful, and you're fearful when others are greedy. Last time around, I think 3 months ago, we were pretty much, if you look at the bottom right-hand side, this is just an S&P 500 ETF. We were right at the top of that channel, that upwards channel that we're trading in at the moment. You can see the whole of 2022, the market was very difficult. I mean, we kind of steadily moving lower as interest rates were ratcheting up. You now have kind of like a recovery off that base, but you're in this upward channel. Last time I met, I said S&P 500 looks expensive. We've now had a pullback straight to the bottom of the channel, and there's a little bit of a concern here. Like I said, on the bigger orange circle, it does look like it's broken a little bit lower from the top channel. It's broken out of the bottom of the channel. It's come in the last, this is a weekly chart that I'm showing you here. So in the last week, we've seen a big recovery up to that level. If you're a technical trader, which I used to do lots and lots of trading, technicals, in my opinion, do work. But you break support, or support becomes resistance. This looks a little bit like a Kisco buy. So maybe weaker equity markets on a technical picture on the S&P 500, on an index level. That looks like we could get weaker markets from here. Obviously, if we break back into the channel, that's what we want to see. Then it'll be a false break, and if we can kind of scrape up the bottom of that channel, great. Then we'll get hopefully a click higher in the underlying equity markets. But very, very difficult to say. I mean, it depends how long interest rates are high. If we see interest rates coming down, maybe we break into the channel. If we don't, and we see a longer plateau, maybe we see much, much weaker equity markets. And then you want to put some capital protected products in place. You want to start switching more towards value in equity portfolios. And that's kind of how we are thinking about it as well. Okay, Gary, what are your views on the probability of recession in the US? I missed the first 15 minutes of the webinar. I'm happy to listen to the recordings. Yeah, so like I said, like we want a recession in the US. That's what we want. I don't really have a gauge of the probability of a recession, but my feeling is if you look at this chart on the bottom right-hand side, and I've got the 3 drawdowns. So, from lows to highs last year, we had a 27.49% drawdown in the S&P 500 ETF, high to low. We finished the year, like MSCI will finish the year around 20% down. I mean, we tracked it down on our equity portfolios as well. Like I said, difficult year last year, but a nice recovery this year for sure. But remember, when we hit the lows about a week ago, that on that breakout there, we were still 14, almost 15% down from highs. So that's that second arrow dropping down there. 15% down from highs. Remember, correction is 10%. We through a correction. This was a proper correction that we've just experienced over the last 3 months. Like I said, last time we said it was too high. We've had a proper correction now. Now we're in kind of like, for me, it's like no man's zone. Like either we're going to break through this and it's going to be a false break, or we start moving lower from here and retest. I'm very, very worried about equity markets. We're currently still around 8-9% down off highs. So still, if a break in here, and if we get the Santa rally, as they say, if this starts moving from fear back into greed, hey, this could be a great time to be buying stock, definitely. And I do think it is. I just don't know if it's a great time to be buying indices. So let's have a look at why I don't think it's a good time to be buying. So to go out and buy that ETF and just go and buy an S&P 500 tracker or an MSCI World tracker, I think you're going to struggle, and this is why. I think this is very much a stock picker's market. Now, if you have a look at what's happened, this is over the last 3 months. It's even more exacerbated if you take, I didn't put an annual heat map up for you today, but if you put an annual heat map up, it gets even more apparent. But you can see what's happening here. The large cap, so the size of the square in this heat map is your market cap. So that's how big the company is. So you can see Microsoft on the top left, Google, Apple, Amazon, Nvidia. These are the big market cap companies. They're green. So that's why. And they're all in this kind of technology segment up on the top left. AMD, Intel, these big tech companies have done extremely well. Look at the rest of the market: real estate, energy, utilities, basic materials, industrials, all red. Most of those companies are red at the moment. And it's what we discussed, not last meeting, the meeting before. The breadth in the market is bad at the moment. So what you have is you've got the Magnificent Seven and a couple of hangers on doing really, really well. And because of their large market cap, their share price performance has lifted the overall index. And that's why if we go back to the index slide, you can see this big recovery. Most of the stocks haven't taken a big recovery. A lot of these stocks are going through the same kind of year that they went through last year. They're actually like really, really struggling. Now, for me, that's kind of where I think some of the opportunities are in the market. It's not this big traditional kind of, I mean, you want to have those blue chips in your portfolio, absolutely, but some of them are getting very, very expensive. As you guys know, last time I discussed it, we trimmed a little bit of our NVIDIA. I mean, we have an NVIDIA position. We've traded around our NVIDIA position for the last 5, 6, 7 years. We've always liked AI as a theme. This year, our AI slant has done very, very well for us. Of course, I mean, enough that we've actually split out and we've created a direct portfolio in AI. We like something like NVIDIA, but NVIDIA had grown so much in the context of my global equity portfolio. It was kind of knocking on the 10% of portfolio weighting, so I reduced it. So we're still holding around 4. I think it's about 4.5% at the moment, depends which day you look. But yeah, we started exiting. We've moved into Chipotle was our buy, a little bit more defensive. Something that we went through kind of like the reasoning of that in the last slide. Obviously, nice big recovery as well. We're already up about $120 on that stock since we bought it. It's actually performed better than NVIDIA. So it was so far a good switch. I mean, we don't know what it's going to look like over time. NVIDIA is a very exciting company, but it is trading at 35 times sales. It's expensive. So what you've got here is you've got this kind of almost this disjointed recovery in the market. And I think where you're going to find real exciting opportunities over the next 3 to 5 years is probably in the red segment rather than in the green segment. Some of these tech companies are looking a little bit pricey for me personally at the moment. But again, a case-by-case basis. I mean, Google is still, for example, is still one of our preferred stocks. A lot of these tech companies are very different, in composition just because they're so cash generative. Their balance sheets are so strong. They are not affected by high interest rates in the same way as a small kind of growth stock would be affected. So, there's arguments both ways, and it's probably a more detailed discussion. Again, we hold Microsoft, we hold Nvidia, we hold Google, we hold Amazon. So of those and we hold Visa. So I was looking at those on the top left-hand side, and we hold CRM. And we hold Adobe. So we are quite focused there. We've taken the run up, but I am starting to get concerned about the levels, and you can start to see how we're responding to that by trimming things like Nvidia. It's one of the reasons that we're going to look at Adobe today as well. If we go to the rest of the world, a similar picture playing out, except you're seeing a little bit more of a recovery, obviously, in the last 3 months anyway. Commodities and energies have done okay. Brazil, you can see something like Vale doing well. You look at Shell, that's green. Accenture, again, it's kind of like the AI theme, but also very, very patchy over the last 3 months. Difficult environment. Okay, so I'm just going to look at commodities quickly. And this, I don't know, again, I think it speaks to the volatility and the fear that we're feeling in markets at the moment. And there's also, I suppose the next 2 slides are going to speak to just, it's so difficult to kind of give you guys like a clear view of markets. I mean, we've got these advanced tools that I can play with, and I can look at it over a million time periods and can kind of play with all these different things. But here is just, okay, so this is basically the commodity moves over a 1 year time frame. And you can see over the last year, we've seen a big drop off in the likes of Brent crude oil. Brent crude oil really has just screamed down over the last couple of days. We're below $80 a barrel today. And I mean, down 18% over the last year. Now, again, we had this spike into Ukraine. We've had, there's an OPEC meeting, I believe it's on the 24th of November. I might be wrong on that, but it's coming up. But we've seen both Saudi Arabia and Russia extending the output cuts until the end of the year. They see a weak recessionary environment. So they see this recessionary environment coming, and they're taking supply out of the market. Saudi Arabia is taking 1 million barrels per day out of the market. Russia's taking out 300,000 barrels per day, if you believe Russia. Because remember, Russia will announce these things, then do whatever it likes anyway. But, and of course, there's all the sanctions and the challenges around Russia, but they are still selling their oil. So they're taking it out of the market, but the oil prices are still falling. And that, for me, is telling me that the market is expecting. Commodity markets don't price as, well, I suppose they price just as quickly, but commodity markets, it's supply and demand driven. It's not kind of the same as equity markets where you're looking at earnings, but giving you an indication that recessionary conditions might be approaching. The only over 1 year that kind of I've done just the general commodity index from Bloomberg and Refinitiv. The only one on this page that's positive is gold. So gold is actually up 16.43% over the last year. So gold as a safe haven asset has actually been doing its job. Last year, I mean, over the last year, stocks have been under pressure, but that kind of that little anchor position, that safe haven in your portfolio would have done well for you. I thought, let me give you 2 over 5 years as well, because that will probably show you a very different picture. But actually, gold is up 60% over the last 5 years. And Brent crude 10%. But you can see, I think what I want you to get out of this this chart is obviously commodities can be very volatile. We see them very much as an alternative position in client portfolios. We're a nice commodity hedge fund that we generally use as commodity arbitrage hedge fund. It's not the kind of thing, you don't go and buy barrels of oil. These are trading things, and what the reason I show them to you is not because I want you to invest in commodities. It's really to try and gauge, like what we're trying to build here is an understanding of inflation inputs. What is happening to food prices? We're using wheat as a proxy. What is happening to oil prices? That feeds inflation everywhere. And gold kind of gives you like a view on what's happening to the price of money as well. So that's kind of that view there. And then obviously I just like to look at the softs as well. Also inputs, inflation input takes money out of people's pockets. People have to pay for food. You pay for food, and if you can't pay for food and food is going up aggressively, you stop spending on other things because you always pay for food. But this just gives you like a broad overview of the softs market. And just interestingly, the thing that's shooting up like that is orange juice. So orange juice just on a rip-roaring ride for the active traders that are watching this presentation. Remember, you can trade frozen concentrated orange juice futures out of Miami on our platform. So maybe there's something to do there. But generally, you can see that all of the commodity prices have moved up. All of these commodity prices have moved up over the last couple of years, and the environment is fairly inflationary. Okay, let's move to currency markets quick. Okay, again, they normally update this around the 4th of the month. So I thought by the 9th we'd have the latest Reuters poll out. It's not out yet, so they haven't pinged all the banks for November. So I'm just working off the October figures. But this is a picture of where the rand-dollar exchange rate is at the moment. I think we're at a level where you should be buying dollars, to be honest. And it's interesting because most of this year, it hasn't really given you a big strengthening. If you look at where the year starts, I don't know if you can see my cursor, but it starts about there. If you didn't take money out literally in the first month of the year, if you didn't use up that SDA allowance and then use your SDA allowance again, you've probably been sitting on the sidelines. And I mean, I know I have. I've got allowances left as well that I need to use by the cutoff, the calendar year cutoff, on the 31st of December. Remember, your SDA allowance, which is your 1 million, that runs from 1st of January to the 31st of December, but you have to get your trades in a little bit earlier because if we can't settle in time, we'll try and settle on the same day, but if we pop the settlement into the next year, we'll use next year's allowance. So, you know, if you're going to do the trades, we're really looking at the next month and a week, say. If you've got SDA allowance and you want to use it, and I think we have the opportunity now. Like, you know, for those who watch this presentation regularly, you know, you have to be an economist to an extent. You know, this is where I think it is. I try and give you guys my honest opinion on everything, and I try and give you a view, not an honest opinion. I always give you an honest opinion. Trying to give you a hard view. It's difficult, but my hard view at the moment is now is the time to take currency out. I think you should be buying dollars here, head on the block. You can see the channel is quite clear on the rand-dollar exchange rate. We're hitting the bottom of the channel. You know, we don't just look at the technical side. We've got an RSI on the bottom. You can see this little strengthening is taking it down to oversold. We hit 1820, and we've kicked off aggressively now. Even at below 1850, I think buy dollars, sell rand. And then, yeah, kind of mid to top of the channel is where I would reverse that trade if you've got dollars and you're bringing back. But yeah, I think an opportune time into the end of the year to use up the balance of SDA allowances now. Looking at the big banks and brokers, why do we poll the big bank? Why do we use the poll of big banks and brokers? Because this is what's feeding into their trading desks. This is their house view on where the currency is. Goldman Sachs is unchanged at 1675. Goldman Sachs is always the most optimistic on what the rand can do. Always. I think they had targets of 12 rand. Not so long coming to the year. I think their target was 12 rand, and I think we went through 20. So. Goldman Sachs is the most optimistic at 17. Then ABSA, kind of a little bit optimistic. Investec's not on here. They didn't publish until the October poll, but we've seen their latest research. They're also fairly optimistic. So they're also kind of in the 17s on a 1-year view. Nedbank at 18, Standard Chartered at 18. And then you're looking at like kind of the bigger banks like Morgan Stanley, JP Morgan. They're looking for 20 plus. This is all on a 1-year view. The median estimate has moved up since we last looked at this. So we last looked at this, the median estimate was around 1758. That's moved up to 1839 as the median estimate currently. So that's where they're seeing the rand dollar out a year. We discussed this at length in our research meeting we actually did it on Tuesday. It's a different, I think that we take out, I think that, and I think it's the feeling of a lot of guys in the desk that there are significant risks. If you compare South Africa to something like Turkey or Brazil, our risk premium is actually quite low. We're seen as an emerging market currency as a fairly strong option. And that can change very, very quickly. That sentiment can change very, very quickly. And if that happens, there's probably more of a risk to a weakening than a strengthening. The strengthening, where will the strengthening come from? It's our feeling that without a big recovery in commodities, we won't see that strengthening. So it's for the rand to pull back, and remember the rand goes through. If you look at the strengthening that I've got on the left hand side of this chart, you can see the rand can go from 20 to 13, or at least sub 14. I mean, that is possible. I mean, we can get 40% moves on it. If you go further back, I mean, you can see, strengthenings from, above 10 to significantly below 10, like 40% moves. Don't ever think that the rand can't do that. This is not a one-way bet. If you're a trader out there and trading geared in currency or super pessimistic and thinking, I'm just going to take everything out of the country, also not probably a good idea, because while my view is that now is the time to buy dollars on a short-term basis, anything can happen longer term, and there's a real possibility if we see interest rates come down and growth starting to kick in again, or interest rates coming down when it hasn't fully quashed inflation, and we see commodity prices really taking off, our currency will do the same thing, and we could easily see a strengthening down to sort of 15. And that kind of heavy dotted line is the long-term trend. So there is the possibility of a break lower as well, but with a month to go, I'm going to be buying dollars. That's all I'm saying. So that's kind of the currency view. I think time to take out for what it's worth. Portfolio review. Okay, so portfolio review. So this is how the portfolio is doing. Remember, this is the global equity portfolio that we started kind of mid-2016. It all sits on the DMA system. And we get like beautiful tracking for this. So this was actually pulled this, I think it was the other day before. So we this is percentages down at the bottom. If you look at the total monthly P&L, that's kind of our month-on-month returns. 14.2%. We've pulled back, like I said. I mean, for guys that have watched this presentation, I mean, there's presentations that I've gotten up and gone, we're really struggling. Specifically last year, like I said, we dropped 20% last year, and we looked great since inception, great on a 5-year view. 3-year view was really not looking good. Then we were looking good on all the other, 6-month, well, it was all looking fine, but that 3-year period was pretty tough. Last year was particularly tough for the portfolio as well, but we've pulled it back massively this year. Like it really, I mean, sticking to our gun. I mean, I've sat on trading desks for a long time. I've run portfolios for a long time. And it's all about, I mean, every portfolio manager will go through periods of underperformance and outperformance. And what is so, so important is when you go, and investors will as well. So take this from where it's coming. If you're managing your own portfolio and you've got a solid strategy that you believe in behind it, you've got to stick with it. You can't let performance shake you out. If you've got a system that you're working to and a methodology that you believe in, you've got to stick with it. And we stuck with our methodology. It's worked for at least 8 years with us, and at previous companies for another 5-6 years as well. So we know that this model works. Every now and again, it goes through a very, very difficult period, which we have been through. But even then, we're back to outperforming nicely. I'm going to show you some stuff there. 14.2% up for the year in US dollar terms, well ahead of our benchmark. Really happy. Historically speaking, so since inception, NVIDIA has, like I said, we trade around NVIDIA as a position. It's been a big beneficiary. Microsoft, Alphabet, Microsoft, some of our core positions for a long time, obviously big gainers. Kind of our value positions, we don't take necessarily just a growth or a value approach to investing. We have a blended approach. Our value positions are what has let us down to an extent. But that's the overall losses from our value plays, if you want to put it that way. But the recovery in the last 3 months since we last spoke, really, Adobe, Microsoft, and Amgen have been the big pushes up. Danaher, General Motors, and JP Morgan have been the detractors from the portfolio. I still think that there is an opportunity just from the value point of view in the US banks. That's why we have Citibank, Citigroup at least, and JP Morgan. Very, very cheap, still beneficiaries. Looking at we've got earnings season rolling on at the moment. You go and look at the bank numbers, they were first to report. What you can see is you can kind of understand why the US is as strong as it is. These banks are making an absolute fortune. They work slightly differently to South African banks. So when interest rates rise, they don't actually lift their deposit rates nearly as quickly as we lift them in South Africa. So, for example, I mean, obviously we have cash deposits and Investec. Repo, at least, repo goes up 0.5%. You've got a call account in Investec. A day later, your call account goes up 0.5%. Like that's how it works. The US is not like that. The US, they kind of don't really compete like that. So their margins have just gone absolutely berserk over the last little bit with higher interest rates, and that's feeding through. At the same time, we were worried. I was watching that for kind of credit impairments rising. They haven't. What's happened is within the banks, the US savings balances have been drawn down, but credit impairments have not increased significantly. So what you have is just a US consumer that is so incredibly robust that even with all the pain and the higher rates and all of that they've been going through, they are still out there and surviving and spending. And that's one of the reasons I think we haven't seen the deterioration in the US economy that everyone was hoping for and as quickly as we'd hoped for. It's just Americans are that rich, which is great, which is the kind of companies we want to invest in that sell products to them. But the bank's doing very, very well. But, we have seen a little bit of unwind. And I think, again, that's the expectation. Remember, we're trying to predict a prediction here. It's the expectation that interest rates are going to fall. And that's maybe why we're seeing a little bit of a softness in the banking share prices. We had sold our Citigroup position. We've only recently rebought into it after the sell-off, but still like the positions. And like I said, we've got a 3 to 5 year view at least on most of our positions. So very, very happy holders of those companies. Okay, if I just go to the next. So this is just like, okay, so I've just given you the top 5. As I said, JP Morgan is one of our top 5 positions. Microsoft, United Health going absolutely berserk. That's a different story. Alphabet and Visa are big plays at the moment. And kind of we're considering them quite closely. Those are our most concentrated positions. As you can see, okay, so while this was pulled a couple of days ago, these figures are actually at the end of October. If you're looking for a full fact sheet, you can find it on our website. You just go to, you just literally front page, click portfolios. You'll see the 3 portfolios there. Click global equity, and you can go and get all the data and the methodology and all of that. But yeah, you can see, I mean, in the beginning when we started this portfolio, we were essentially tracking the market to a large extent. And, I always tell a story to new clients about, it's that story, I think it's a Malcolm Gladwell story about the US cycle team, or at least the UK cycle team, about how do you generate a significant lift in any performance. And the way that you generate a lift in performance, it's very difficult for me to go out and be 10, 15, 20% better than an index. Like that's almost impossible. Very difficult for me to do that, even be 10% better than another active manager. So the way that we do it is we try and get like 0.5%, like, I mean, our fees are lower. The way that we execute into seg portfolios is cheaper than the way that guys do it. If you unitize a CIS, we handle our own internal trading. We've got a whole trading arm. Like I said, all you self-directed traders, we love servicing you, but I also love your flow because it makes my institutional cost incredibly low. And it's all these little savings, these little 0.5% that add up to like a significant outperformance. And you can see that in the chart as well. Like as we started, I mean, we were very much tracking what the market was doing. And then slowly all those little pieces of alpha, like little 0.25% there, 0.5% there, start to add up over time. And that's when our performance, and that's when we started to see the splitting between our portfolio and our underlying benchmark. Like I said, on the 3-year view, we started to underperform. I was a little bit overly conservative, but like I said, you're seeing that that's starting to widen again. I'll show you a better graphical representation of that in a second. So you can just see this is a 1-year scatter chart. So what I plotted this against Earth, URDH, which is the MSCI World ETF that you can invest in. And you can see on a 1-year view, we are lower in terms of volatility. Our volatility, vol at 13.03, their volatility at about 13.5, but our performance over 1 year is significantly better. So, I mean, we're looking at... okay, so this was pulled. This is a historic data. It's not matching the data that I just pulled off the system, but we were at about 12.5% up for the year there, whereas they were only up about 9.6. So as you can see, like a nice 3-4% outperformance that we have currently over the MSCI World, which is great. Then if you look at the chart on the top left, this is just like basically a relative outperformance view. So you can see, like I said, the first couple of years, if you look at the 2016 to 17, there was no outperformance. We haven't outperformed it all. We were just, you might as well have bought an ETF at that stage. And then we started the steady outperformance that you saw that kind of opened the jaws up. Then like I said, COVID, we actually did exceptionally well on COVID. And we were already putting out research. We had already become quite conservative into the crash. And if you actually look at the bottom segment here, you'll see what I'm talking about. I mean, we had COVID, the market, we had massive drawdowns in the underlying market, and our drawdowns were a lot lower. But then when recovery came, our recovery was a lot faster as well. So that's when we got this big outperformance into COVID. And then, like I said, I got a little bit too conservative because I'd gone through this and I just didn't believe that we're out of the woods yet. And we kind of tracked markets sideways for a while, and we just underperformed a little bit last year in 2022. Although even though our point-to-point performance was perfectly in line, we were down 20. The benchmark was down 20 as well. It doesn't help clients, and it kind of like annoyed me a bit. We kind of stuck to our knitting, and now you can see that starting to tick up, and we've had a nice year of outperformance again this year, which I'm really proud of. I haven't updated this from last time, but I think a lot of clients actually like kind of pinged me afterwards. They just sent me messages on that afterwards. So I thought I'll just leave it in when I was updating the presentation. So we benchmark against an ETF. I benchmark against a price index that doesn't even have fees, because we don't take performance fees on these portfolios. We literally take a management fee, and the benchmark is just a hypothetical. It's something that, we could benchmark against anything, but it's to give us a gauge of, hey, is the general world under pressure? Oh, that makes sense. We're under pressure. So that when you are down 20%, you're not panicking. You're sitting there going, oh, but everything's down. And how do we adjust in a way that is sensible so that we can create alpha on the upside? So that's why that benchmark is in place. But I decided, why don't I just benchmark? I didn't give, obviously, the names. I just did big gold, big green, and big gray. You can probably guess who these are. And these are their equity portfolios. So bottom chart is over 5 years. I mean, we comfortably beat them. I mean, our 5-year return, this is as of the end of last quarter. I mean, we were up 53%. The next best big asset manager in South Africa is up 43. The other two are up 27.5 with the same mandate that we have. And like I said, it's difficult when you're managing R500 billion to be as nimble as we can be when you're running a seg portfolio for clients. So top chart, like I said, it's actually an arithmetic mean. It's slightly different, and it's also a 3-year time horizon. It was just what we could get off the system. But also our volatility among the lowest. I mean, we are the best in terms of volatility as well. So just a little look at what the portfolio does and why we're kind of proud of it, rather than just looking at the overall performance and going, 14%, that seems good. Okay, and then let's have a quick look at Adobe. So there's only, like I said, we're only doing one stock today. Let's say Adobe. Yeah, so let's just have a quick look at Adobe. Yeah, so obviously you guys probably all know what Adobe does. I think everyone, and it's part of the investment case behind the stock and why we like it is that it is an incumbent. And one of the beautiful things about a global equity portfolio is you can go and buy the biggest and best companies in the world, the best products ever. And I think you'd be hard pressed to find a business, a bank, or an individual that has not ever used an Adobe PDF. I mean, if you've opened a bank account, you've used an Adobe PDF. Like if you've bought a house, you've used it. I mean, it is, especially in a paperless world, it's pretty much the standard for contracting. So, I mean, that's part of it. Of course, they've got a lot of other businesses within this. I mean, I used to program in ActionScript, which is like essentially Flash, which was Adobe. It's now part of Adobe Creator Suite. But I mean, Photoshop, all the different Adobe Illustrator, all those Adobe products as part of the Adobe Creative Suite. That's what they sell. One of the risks to it is that's what they sell. That's all they sell. It's an incumbent, but it's not exactly a diverse business doing a million different things. That doesn't really worry me. Like I said, I've kind of I've put that as one of the risks of the position. It doesn't really worry me because that's why we take a portfolio approach. You hear sometimes, we want something like Bidvest because it gives us exposure to all these different things. I'm a portfolio manager. I'm buying individual things. I'm giving you like a wider exposure to many different things, like banks and insurers and people at Gillette razor blades. These are all things that the portfolio will do. So I don't mind having excessive concentration. If it's the only stock in your portfolio, be careful. That's one of the risks. But it's become wonderful business, very, very predictable growth. So through their software as a service. So with this, if you're paying licensing fees, which is primarily where the income comes from, it's very, very stable, very, very predictable. I didn't put up revenue and EPS charts here, but if you look at how the revenue growth and the EPS charts, it is so stable. There's a high degree of predictability in the business. Earnings growth, we believe, over the next, say, 3 to 5 years, is probably going to average between 12 and 16%. Revenue growth is going to be hovering around 12%. That's what you can expect. And like I said, very easy to model because of the predictability of software as a service inflows. Looking at the latest earnings, management lifted both the top and the bottom line outlook. It is looking really, really good for Adobe at the moment. Part of that is also, it has, from a stock price point of view, been a beneficiary of the whole AI theme that's played out this year. You might have played, I don't know if anyone has played with it or you might have seen videos of it. It is absolutely incredible. It's called generative AI. You open up your Photoshop and you draw a line around, I think the one that I was looking at it's one of the adverts, which is they draw a line around like it's like a stag sitting in a forest, and they say, and you just type in draw street scene, and the next thing there's a street scene, then you cut the sign out and say put in a neon sign, and a neon sign arrives, and it is unbelievable for creators. And what I like about it is so much of the AI hype that we've seen so far is potential future income based on products that will be created. Adobe is actually using AI technology in products that are on the shelf. And when I say the shelf, the digital shelf, and being sold today. And this is a very cash generative business, and it's good. The other thing, as you know, a lot of our approach is based on like it's almost a quantitative approach, but we also believe in bottom-up analysis done by professional institutional analysts. We also want high coverage on stocks. One of the wonderful things about investing in the US, you don't get things like Steinhoff when you have 50 analysts covering a stock. The problem where listed companies are run badly is when you have the principal agent problem. You have a big asset manager that owns 35% of a company, but it's only 0.8% of their portfolio. They don't even look at the stock. They don't even have an analyst covering it. And it's this big dead capital that sits in a company where there's a management team that owns no shares and just pays himself a fortune. I mean, and there's no analysts covering it, so no one's even watching to see if there's anything wrong. The investors, the institutional investors don't even care what's happening inside the company. And that is the time when bad things happen to companies. That doesn't happen in the kind of companies we invest in, because we're investing in some of the biggest and best companies in the world. Here, we have 35 analysts, institutes. This is Morgan Stanley, Goldman Sachs, and I've got Bernstein up there. So Bernstein raised their target price on Adobe today. All covering the stock, all engaging regularly with management team, keeping the business honest. And that's why we like investing the way that we do. And I do put a lot of stock in analyst research and proper analyst research. I know everyone has their own theories on it, and like you'll hear all the guys shout, it's where expectations are set. And we can debate that as much as you want, but it is where expectations are set in the market. The implied upside on Adobe at the moment is 13% on the BPA, at least on the Bernstein target. Current price is 585.31. They're looking for 660 on the stock. Short-term traders, you might want to have a look at that. I've got a chart up on the left-hand side. We bought maybe a little bit early, and I mean, it's a new thing that I keep chatting to guys about. We have, in terms of our quantitative model and in terms of the way that we select shares, we have very, very good models to understand when a share is attractive and when it is showing good valuation. Very, very accurate models to tell you when a stock is cheap or expensive. Timing is incredibly difficult. We know when a stock is good value, but it's very difficult to tell when everyone else is going to see that value. That's a much more difficult game. But if you keep on buying stocks when they're showing good value and you hold and you're patient, it will pay out. So we bought Adobe, I don't know if I put the date up, I think it was the 29th of March 2022 is when we added Adobe to the portfolio. There'd been a big re-rating there, and that little blue arrow on the left-hand side is the day we bought it on the model. and for everyone else. And we went through obviously everything. Anyone who allocated capital after that obviously got Adobe at much better prices. And I was looking at some of the new portfolios. Adobe's like up 50, 60% for them. I think it's up 78% for the year so far because they were just buying a little bit. We bought maybe a little bit too early, but no one gets the bottom. And we're not worried about that. From where we bought, it's currently up about 26% in US dollars after, call it a year and a half. And it's breaking higher at the moment. Target price is higher. There's institutional support as well. The one concern that we have about it is the concern that I've already flagged in the beginning of the presentation, is trading at over 14 times sales. 14 times sales is a huge, huge valuation to put on a stock. What is that? In the old days, you just shake your head and go, that's not possible. But like I said, great business, very predictable earnings. You can understand, at revenue, if revenue is going to grow at around 12% a year, paying 14 times sales, maybe not a terrible thing. But if you compare that to some of the other ones, just to give you a sense, Microsoft sitting at about 12 times sales, Nvidia at 35 times sales now, Google only at 5.5. One of the reasons Google is still a bigger position in our overall portfolio, the valuation from a tech point of view looks a lot better. But I think there's a little bit, like my personal opinion on Adobe, still got legs to run. I think Bernstein's going to achieve that target. I think it is going to go up. That looks like a very positive share price movement. But if I was on the analyst bench, you've got 26 buys on the stock, you've got 9 holds, I would be moving towards from the buy to the hold side here. I think there's another leg up. That looks like a breakout to me. But when this gets to sort of like 630, 640, I would probably say we're approaching kind of full on this. Hopefully there's a little bit more, if we get interest rates cut, this thing can do 800, no problem. But if we see a target, if we see it go up to 800, we'll probably be lightning on Adobe as well. So that's just kind of the view on Adobe. And I'm kind of out of time. I mean, that's actually the presentation. So if you do want to invest in something like the global equity portfolio, $50,000 minimum. Sorry, that used to be not so much, but now you have to times it by 18.5, so 1850 at least. So it is quite a hefty entry point. But it's the beauty, in a CIS, if you want to invest $100 Rand a month in a global portfolio, index, go for it. Unitized product, go for it. If you have the capital, this is a better way of investing, in my opinion. And then I've got a whole lot of investment ideas for you guys, but we're out of time. So investment ideas, like I said, we did chat about this before. I've got a whole presentation of that, which I wonder if they can link it in the contact card on the YouTube clip. Maybe they can show you the old presentation. We are rerunning this global growth note for those that are familiar with it. It's simply a weighted average of the S&P 500, weighted basket of S&P 500 Nikkei and Euro stocks. It gives you 40% downside protection. Upside cap is, we're advertising at 76%. The one that we closed 3 months ago, which did close, we got a final entry price for clients at 80% upside. So it was 2 times upside on the return. It wasn't 190% participation, it was 200% participation. Remember, we pass any benefit that we get on the underlying execution straight to you as a client. If we can execute at 2.1, 2.3, you will get that. So essentially their cap moved to 80%, so it was better than 12% per year that you will get on the note if markets do well. If you guys, like I said, I don't really have time to go through all of these, but if you guys are interested, just send an email to us or WhatsApp if you've got my direct number, or call the desk and the guys will be more than happy to take you through the mechanics of this in detail. But essentially, for those that understand these notes, anything. If you look at that chart there, anything between the blue and the orange line is almost a guaranteed outperformance zone. Markets fall 20%, you get all your money back. Markets fall 39%, you get all your money back. You guarantee to outperform in a down market. If the market, so if this weighted basket of S&P 500 Nikkei and Euro stocks falls 50% in 5 years, very, very unlikely, and I've got a chart later on that will show you what they have done historically. Then it's the same as if you bought an ETF. You're going to take a haircut. It is still an equity type product. Obviously, on the upside, if the market goes up 10%, you're going to go up 20%. If the market goes up 40, you're going to go up 80. If the market goes up 50, you're going to go up 80. If the market goes up 60, you're going to go up 80. So you only start to underperform if the market is up more than 80% over the next 5 years. That's when you're going to start to underperform. And that's it. I think in a sideways market, if we kind of are getting a bit concerned about valuations and how long those interest rates are going to remain high, a product like this will outperform in sideways and down markets. I've got a couple of scenarios if you want to understand it, but like I said, out of time. This is basically historic back testing. Never been a breach of 40% on this basket. Yeah, so the basket looks good. The second thing, we just closed a triple index auto call, also a lovely product. We advertised at 35% capital protection with a 14% coupon. We succeeded in striking yesterday with a 15% coupon. So we passed on the gain 15% per year that you're going to get on this auto call. Also, I think a very nice note in the sideways market. I'm not going to run through the basics. We'll do that in a separate presentation, which can be linked over here for the YouTube channel. Yeah, and that's so that's just the mechanics of it. Why did I select an auto call? So we ping the market regularly to see what the coupons are. And you can see this is over the year. I mean, we were getting up at about 14. These are all the different issuers. So JP Morgan, Morgan Stanley, BBVA, like all different issuers that we ping Credit Suisse to see what they'll give us in terms of coupon through the year. With the little volatility spike in the market coming down, we reset these index levels at beautiful, beautiful levels. And you can see we were getting above a 14, almost 15% coupon at the beginning of the year. The coupon dipped off. It's just recovered back up. So we thought, let's roll the auto call out into the stronger market, into the stronger coupon market. We've now struck that, and the new product is going to be this growth note. If you kind of want to understand what does this look like over time, so this is just like the 5-year performance on S&P 500, Nikkei, and Euro stocks. And you can see the chances of these being positive over 5 years, I think, is pretty good. But yeah, we can do more detailed historical backtesting. If you're interested, as I said, we've got obviously all the different services, clients that do it themselves, clients that we do it for them, and clients that need our help to tell them what to do all together. Securities broking, managed solutions, and wealth and advisory. To get started, obviously, we have to do KYC with you. We've got lots of different providers. Of course, I haven't even updated the slide because we won more awards this year. So thanks, guys. Thanks for everyone who voted. I really, really appreciate it. We've now been ranked the #1 securities broker in South Africa 4 out of the last 5 years, and they gave us a whole lot of other prizes as well. So thank you very much for all the support. If you want to know more about us, we do free research notes. Viv does a weekly wrap. It also goes up on YouTube. Worth going and listening to him. Always got interesting ideas. Christo sends out online trading ideas for clients. And of course, we've got Anthony Clark, who we distribute his Small Talk Daily research to a very, very select list of private clients. And that's it. So thank you, everyone, for listening. I went a little bit over time. But yeah, hopefully you found that useful. If there are any questions, I will stay on just to answer anything, but I think we kind of did answer them as we went along. But yeah, if there's anything else, please hit me in the chat window or the Q&A box. Okay, I'm going to take that as everyone asked their questions as we went through. So thank you, everyone, for attending. And I think the next one that we're going to do, we won't do another one before December, but the next one that we're going to do is going to be what to expect in 2024, where me and Viv do that joint presentation for you guys, and we make 25 big predictions for the year, and obviously we review our 25 predictions. So we got the yen, that's the one that we did get this year. We review and we score ourselves on how well we did, and we score against the audience, and you guys all participate, and you go and vote, and you go and answer a 25 question survey, just saying where you, like a poll, so saying where you think the markets are going to be, and we see if our predictions are better than your predictions, and if you are the winner, we give you a prize. And if you are a winner, you probably get a prize, maybe with an offer of employment. I don't know. But yes, always a fun one to do as well. So we'll see you guys in January. There's a couple of other presentations going into the end of the year, but you can find all of those on the event portal on the website. They're all free because we like to service you guys and make sure that you're happy. That's why we do this. Do you have okay, so I've got another question. Do you have a product where one can invest in individual shares but within a pension structure? Yes, we do. That's how I do my local share portfolio. It's very, very simple. So it depends on the pension structure. You talk to one of our wealth advisors about like the specific pension structure that you have. But let's say it's a retirement annuity or a living annuity. Even in a retirement annuity where you're limited to obviously having local versus offshore exposure and all sorts of things, as long as the PSP, which is the personal share portfolio, is 250,000 Rand and above, it's not a problem. We literally take over the RA or the living annuity. We like I said, we link to all the different providers: Sanlam Glacier, Momentum, Alan Gray, 91. You tell us where you are or who you prefer working with, or we'll guide you with that. We literally bring across the product onto our system. We put a personal share portfolio inside it, and then we can manage the PSP from within there. I think that answers your question. Very, 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 very simple to do. We do it for a lot of clients in living annuities. There we prefer, at the moment, it's between DMA and Swissquote, our two underlying custodians. But yeah, we can manage offshore shares directly for you guys inside the pension structures, and of course inside the tax wrappers as well. I think Kyle did a presentation on that recently. So absolutely, it's available. It is very, very beneficial to do it that way within a personal share portfolio, because one of the drawbacks of the personal share portfolio structure is that whenever we sell a security, you can look at it as tax harvesting as well as capital gains tax harvesting. You sell, if we switching out of, let's say, 5 to 10% of our portfolio, it's going to create a little bit of CGT for you to use up your exemption. But if you've got it within the pension wrapper, it makes no difference to you, because all of that is your CGT is not being applied, because you're going to basically withdraw it as income later in life. So it is a very, very efficient way to run a personal share portfolio. Why I run my local share portfolio through my RA. So it's something that I do. Post-retirement investment options beside Reg 28 funds. Yeah, 100%. So living annuities as well, no problem whatsoever. It's just, like I said, I talk about the Reg 28 framework because I'm not 55 yet. So it's the way that I do it for mine. But like I said, we have lots of living annuity clients where we run the PSPs underneath them. And yeah, like I said, it's really, really a very efficient way of administering a personal share portfolio, because every time we switch, there's no CGT in there. So we can do all the switches for you, and you get all the benefit of the lower cost structure. The lower the management fees, the better execution. You don't have to have it wrapped. Greater transparency, lower trading costs, all of that applies. But you don't have the one drawback, which is that you keep on releasing CGT when you sell shares. So even if we trade actively within the portfolio, which we don't, I mean, like I said, we have a 3 to 5 year view on most of our positions. Every now and again, like with Monsanto, for example, I mean, we saw the deal was closing at $128, I think it was, and we could buy it at $100, and we had like 28% for free in 6 months. And I mean, our assessment of the deal is that it wouldn't fall apart, and it didn't, and we made 28%. In 6 months. I mean, like, there's stuff like that is going to be shorter term in nature, but yeah, typically we do have slightly longer holding periods. But yeah, really, really efficient structure for post-retirement investment options as well. So good, nice questions. Yeah, very good questions, because that's something that we're particularly excited about. It's one of the reasons I hired all these CFPs so that they could assist you guys with this stuff. So there we go. And like I said, post-retirement, it's super simple. You just convert it, and it was in your retirement annuity, now it's in your living annuity. So there's no impact on you that way either. So it's a nice way to run investments. Okay, good. Thank you everyone for listening, and yeah, hope to see you again at the next presentation. Goodbye.